Have you ever just stared at a 100-page financial standard and felt your brain just melt? Well, what if I told you there's a secret framework that the pros at the Big Four accounting firms use to basically master any IFRS standard in like 10 minutes? Let's break down exactly how they do it.
Okay, so picture this. You're a junior analyst. We'll call him Ryan. It's 9 a.m. A massive, super technical document gets dropped on his desk, and a senior partner is waiting for his expert summary. The clock is ticking. And listen, this isn't some made-up story. This is the daily grind in the world of high finance.
And yeah, it's not exactly a beach read. We're talking 120 pages of really dense, technical, and honestly pretty confusing rules. This is IAS 36, the standard for impairment of assets. It's a beast. And that deadline? Get this, just 15 minutes. 15 minutes to read it, understand it, and get ready to brief a partner on all the key risks, the weird exceptions, and all the disclosure traps. I mean, it sounds completely impossible, right? So how in the world did Ryan actually pull this off? How did he walk into that partner's office looking cool and confident and just nail the summary? I'll tell you this much. It's not magic. He used a secret weapon, a universal framework that was perfected inside the world's top accounting firms. We're talking Deloitte, PwC, EY, KPMG. It's what they call the 10-minute decoding model, and it's designed to crack any IFRS standard, no matter how ridiculously complex it seems. Right, so this is the absolute core of the whole method. Every single IFRS standard, every single one, is built on just 6 pillars. You've got scope, definitions, recognition, measurement, disclosure, and then finally exceptions. If you can just find these 6 things, you've pretty much cracked 80% of the standard right there, instantly. All right, let's take a quick tour through each one of these pillars. Think of it this way. Each pillar is designed to answer one single critical question. You just put the answers together, piece by piece, and the whole picture comes into focus. First up, we've got scope. The question here is super simple, but absolutely vital. What does this standard actually apply to? And maybe even more important, what does it exclude? This is what draws the boundary line, you know? It tells you where the rules start and where they stop. And believe me, the stakes for getting this right are incredibly high. Misinterpreting the scope? That's not just some little academic error. Just look at WeWork back in 2019. They totally exploited the scope of the leasing standard, IFRS 16, to keep these massive lease commitments off their balance sheet. And what did that do? It artificially inflated their key performance metrics right before their IPO. Huge deal. Okay, let's move on to pillar number 2, definitions. The big question here is, what are the key words that decide literally everything? You have to read these terms like a lawyer, because in the accounting world, this is the legal language of finance. And the cost of getting just one definition wrong, it can be absolutely staggering. Look at this number, 1.1 billion euros. That's how big the financial restatement was that Telecom Italia had to make back in 2014. And it all came down to them misinterpreting what directly attributable meant under the standard for intangible assets. One little phrase, €1 billion impact. Insane. All right, pillar number 3 is recognition. Now, this is really the heart of every single standard. The question it answers is fundamental. When do you actually record something on the financial statements? This little piece of the puzzle determines what even shows up in the final report. And this is a perfect example of how these are not just abstract rules in a textbook. In 2022, British Airways used the probability threshold, that's a key part of the recognition criteria in IAS 37, to avoid recording a massive £500 million provision for flight refund claims. The entire decision, all that money, it all hinged on that one single recognition rule. Next up is pillar 4, measurement. The core question is pretty straightforward. How do I calculate the amount to record? This is where the numbers actually come from, the valuation rules. It's also where something like 70% of all accounting errors happen, so this is a big one. And the numbers here can be absolutely mind-blowing. $17.5 billion. No, that's not a typo. That is the impairment charge BP took in 2020 under IAS 36. And why? Because their assumptions, the key inputs for measuring the future value of their oil assets, changed. That's what measurement is all about. It's valuation. Okay, moving on to pillar 5, disclosure. The key question you need to ask here is, what hidden details have to be revealed? This is the story behind the numbers.
This is where companies are forced to come clean and tell you about the significant judgments they've made and the risks they've taken. The whole Wirecard scandal shows you exactly why disclosures are so critical. With that German company, one of the first huge red flags, way before its massive 1.9 billion euro fraud came to light, was its lack of detailed revenue disclosures. It's true what they say. Sometimes what a company doesn't tell you is the most important signal of all.
And finally, we've got the sixth pillar, exceptions and special rules. The question here is super practical. Where are the shortcuts and the loopholes? This is where the real experts and the senior accountants always look first. They're trying to find those practical expedients, the special carve-outs, or any transitional release that can make their life easier. So now that we have the six pillars, let's look at the master tool that pulls it all together. It's called the three-box summary. And this is what the pros use to boil everything down for a partner meeting or even for a high-stakes job interview. It gives them like 90% of what they need to know in a matter of seconds. So here it is in action for IAS 36, that impairment standard we were talking about at the start. Box 1, you've got the core principle, just one simple sentence. Box 2, the three most dangerous areas where things usually go wrong. And box 3, a killer real-world example, like BP's $17.5 billion write-down. See? This is what clarity looks like on a single slide. But the real power here, the real secret, is that this framework isn't just for one standard. It's not a one-off trick. It's a universal key. Honestly, it doesn't matter how complex or intimidating the standard sounds. IFRS 3, business combinations, IFRS 13, fair value measurement, IAS 38 on intangibles, they all have the exact same skeleton. They are all built on those same six pillars we just went through. And once you see that pattern, you can't unsee it.
So, there you have it. You now have the framework to decode all that complexity and find the real signal in all the noise. The only question left is this: which standard are you going to decode first?